Imagine waking up one morning to find half your investment portfolio wiped out overnight. Scary, right? Most people don't think about risk management until it's too late. They chase the hype, throw all their money into the next big thing, and then, bam! The market takes a turn and they're left holding the bag. But smart investors, the ones who consistently build wealth, never let that happen. They understand that protecting your downside is just as important as chasing those big returns. In this video, I'm going to show you how to protect your hard-earned money with risk management strategies that even top investors swear by. Let's dive in. Alright, let's talk about diversification. Think of your investments like eggs in a basket. If you drop one basket with all your eggs in it, you lose everything, right? That's what happens when you put all your money into one stock, one asset class, or even one sector. But now, imagine you have multiple baskets, each with a different kind of egg. You've got your chicken eggs, your duck eggs, maybe even some quail eggs for good measure. Now if you drop one basket, yeah, it's a bummer, you lose some eggs, but the rest of your eggs, they're safe and sound. That's diversification in a nutshell. It's about spreading your risk across different asset classes. Don't just invest in stocks. Look into bonds, real estate, maybe even some precious metals. And within each asset class, diversify even further. Don't just buy tech stocks, sprinkle in some healthcare, some consumer goods, some energy. The more diversified your portfolio, the less impact any single investment will have on your overall returns. Now I know what you're thinking. Graham, this sounds like common sense. And you're right, it is. But you'd be surprised how many people skip this crucial step. Diversification may not be the sexiest investment strategy, but trust me, it's the foundation of a resilient portfolio. It's about sleeping well at night, knowing that even if one investment takes a hit, your entire financial future isn't going down with it. Let's talk about stop-loss orders, one of the most powerful tools in your risk management arsenal. Imagine this. You buy a stock at $50 per share, feeling optimistic about its potential. But then, the unexpected happens. Bad news hits, the market takes a downturn, and your stock starts to plummet. Now, you could sit there glued to your screen, watching your investment dwindle, hoping against hope that it will rebound. Or, you could have a plan in place, an automatic safety net that protects you from further losses. That's where stop-loss orders come in. A stop-loss order is essentially an instruction you give to your broker. If this stock drops to a certain price, sell it automatically. So in our example, you might set a stop-loss order at $45. This means that if the stock falls to $45 or below, your broker will automatically sell your shares, limiting your potential losses. Stop-loss orders aren't about trying to time the market perfectly. They're about managing your risk and protecting your capital. Think of it like this. Would you rather lose a small amount of money on a trade that didn't go your way, or risk losing a significant portion of your investment by holding on too long? Now let's talk about position sizing, one of the most overlooked yet crucial aspects of risk management. Even if you've diversified your portfolio and set up stop-loss orders, you can still get into trouble if you're not careful about how much you invest in any single trade. Position sizing is all about determining the appropriate amount of capital to allocate to each investment in your portfolio. It's about finding that sweet spot between maximizing your potential returns and minimizing your risk. The key principle here is simple. Never bet the farm on one trade. No matter how confident you are in a particular investment, never put all your eggs in one basket. So, how do you determine the right position size? Well, there are a few factors to consider: your risk tolerance, your investment timeline, and the volatility of the asset you're investing in. If you're risk-averse, you'll want to keep your position sizes smaller. If you have a long investment horizon, you can afford to take on more risk with larger positions. And if you're investing in a volatile asset class like cryptocurrencies, you'll want to be more conservative with your position sizing. A good rule of thumb is the 1% rule. This rule suggests that you should never risk more than 1% of your total portfolio on any single trade. This approach helps you avoid catastrophic losses and keeps you in the game, even if you experience a string of bad trades. Remember, investing is a marathon, not a sprint. It's about preserving your capital and letting your profits compound over time. Let's talk about hedging, a strategy that can feel a little more advanced but is incredibly powerful for managing risk in your portfolio. Think of hedging like carrying an umbrella when the market forecast predicts rain, or in our case, losses. When you invest, there's always a chance that the market could move against you. But with hedging, You're essentially taking out an insurance policy on your investments, protecting yourself from potential losses. Now, there are various ways to hedge your bets in the market. One common approach is using options. Options contracts give you the right but not the obligation to buy or sell an asset at a specific price within a certain time frame. By strategically buying and selling options, you can create a hedge that offsets potential losses in your portfolio. Another popular hedging strategy is investing in assets that tend to move in the opposite direction of the market. For example, gold is often seen as a safe haven asset. When the stock market takes a hit, investors tend to flock to gold, driving up its price. So holding some gold in your portfolio can act as a hedge against a stock market downturn. Hedging can get a bit complex, and it's not necessarily suitable for all investors. It often involves additional costs and can eat into your profits if the market moves in your favor. However, if you're looking for ways to protect your portfolio from significant losses, especially during times of market uncertainty, hedging can be a valuable tool in your risk management arsenal. We've covered a lot of ground today, from diversification to stop-loss orders to hedging. But here's the thing, none of these strategies will matter if you can't control your emotions. Your biggest enemy in investing isn't the market, it's yourself. It's those moments of fear and greed, those impulsive decisions driven by emotion rather than logic, that can wreak havoc on your portfolio. Think about it. How many times have you seen a stock dip slightly, panicked and sold at a loss only to watch it rebound a week later? Or on the flip side, how many times have you gotten caught up in the hype, bought into a stock at its peak driven by FOMO, fear of missing out, only to see it crash and burn? It's human nature to react emotionally to market swings. But as an investor, your job is to recognize these emotions and not let them dictate your actions. So how do you master your emotions and make rational investment decisions? First, have a plan. Before you even think about investing, define your financial goals, your risk tolerance, and your investment strategy. Having a clear plan in place will help you stay focused and avoid making impulsive decisions based on emotion. Second, educate yourself. The more you understand about investing, the less likely you are to make emotional decisions. And finally, remember that investing is a long game. Don't get caught up in the day-to-day fluctuations of the market. Focus on the big picture, stick to your plan, and tune out the noise. So there you have it. Those are the risk management strategies that can help you protect your hard-earned money and achieve your financial goals. Remember, investing isn't just about picking the next hot stock. It's about managing your risk and making smart, calculated decisions. Now I want to hear from you. Which risk management strategy resonates with you the most? Drop a comment below and let me know. And if you found this video valuable, hit that like button and subscribe for more investing insights delivered straight to you. Let's build wealth wisely together. Your first audiobook is free. Experience best-selling thrillers, powerful self-development, and epic adventures. Start your free trial now. Only $2 per month after your 30-day free trial. And guess what? You can cancel anytime. No risks, no regrets, just powerful storytelling. Start listening today. But wait, there's more. Get the world's greatest books for personal growth and wealth. 4 life-changing books for just $4. How to win friends and influence people. Build lasting connections. The power of your subconscious mind. Unlock limitless potential. The richest man in Babylon. Master wealth-building principles. Think and grow rich. Achieve your dreams. Don't miss this unbeatable deal. Order now for $4 in the Intelligent Investor books, links in the description.